Hello and welcome to Academy of Value Investing. Today we'll discuss what exactly is discounted cash flow, and I'll actually show you a live demo of how it's done. So basically discounted cash flow is one of the most recognized ways to value any stock and find its intrinsic value. It's easier than what it sounds, and I'll try my best to simplify it as much as possible to make it easily understandable. Now let's start with the very basics. If you had two options that you can get rupees 100 today or rupees 104 an year down the line, which option would you prefer? Personally, I would prefer to get 100 rupees today because I can anyways do an FD of that amount, and after an year I'll get 107 rupees. So why should I get 104 rupees after an year when I can take 100 rupees today and make it 107 an year later? So this is how you compare what is good for you. This is in fact what we do while we buy a property. We decide on the basis of whether this property will be good or not 5 years down the line. If there's a flyover coming or an airport coming or a shopping mall coming, you want to pay more for that property because you know that in the future the value will rise. So when the future value will be good, it's okay to pay an X amount to get that X plus 10 amount in the future. So when you are doing all this, you are basically discounting the future value, the future increased value of a property or a shop or the stock, and you are judging what is the present value of that future expected value. So what is the present value of getting 120 rupees in future, say 2 years down the line? Actually, let's take a simpler example. If you were to give me 10 rupees 1 year down the line, how much should I pay? Will I pay 10 rupees to get 10 rupees a year later from you? No, my net return would in fact be negative after adjusting to inflation. Not a good deal. Will I be paying 9 rupees? Well, if I pay 9 rupees to get 10 rupees 1 year down the line, my returns are roughly 11-12%. Not good enough. I can get more than that from mutual funds or equities. What if I pay 8 rupees to get 10 rupees 1 year down the line? Well, if I pay 8 rupees today and get 10 rupees 1 year down the line, my return is 25%, which is very good. I might get that in stocks, but I'll definitely not get that in mutual funds. So 25% is a very good return in a year, and I would definitely go for that. So my present value for rupees 10 an year down the line is 8 rupees. So how did I arrive to this present value? By doing, in a way, a simplistic form of discounted cash flow. So now that you know the basics, now that you know what we do, understand that discounting is basically the opposite of compounding. In compounding, what you do is, if you have 100 rupees today, if you get 10% return, you will have 110 rupees 1 year down the line. In discounting, we do the opposite. If we have 110 rupees 1 year down the line, you discount it and determine what is the present value of that today. So it's exactly the opposite of compounding. Now let's discuss the elements of compounding. So the first element is you need to calculate the initial free cash flow. Now what is cash flow? Cash flow basically is slightly different from net profit. In net profit, what happens is you book sales and you show that, okay, this product got sold for this much price, here is the bill, and I'll get this much profit. But that profit might not come if the buyer does not pay you. So wherein in cash flow, you only book the cash that you actually receive. So all the bad debts are never included in the cash flow. In cash flow, you get what is actually paid. So cash flow is a more conservative and more realistic figure to tell you how much surplus cash are you generating from the business. So free cash flow tells you that after paying all the expenses, after buying all the new machinery that you needed, after all your expenses, what is the surplus cash you have with you? What is the cash profit that you are left with? That is free cash flow, because the company is now free to do anything with that money. So it's called free cash flow. So the first thing you need to do is to determine the 3-year average cash flow of the company. So say if the cash flow in the first year was 100, the next year was 150, and the next was 200, you add up all these three figures and divide it by 3. So you get the average free cash flow. That's the first thing you need to do. I know it looks a bit difficult, but this is the reason we are coming up with our own stock analysis website that will be free for the retail investor. And as soon as it's available, the link will be updated here. So this is the first thing that you need to do. Now the second part. You need to estimate that by how much these cash flows will grow. So if it's a fast growing company, this cash profits could grow faster. So probably I'll take 10 to 15% if it's a mid cap. If it's a small cap, I'll take this assumption to be 15 to 20%. So first you need to estimate by how much these cash profits will grow in the next 5 years. Then you need to estimate by how much will these cash profits grow in say 6 to 10 years, which is a lot harder to estimate because it's further down the future. So I'll take a much more conservative estimate to compensate for the future uncertainty. So I'll take a lesser figure. These two assumptions done. Now the next assumption is that how much returns do you want from the stock? So say I prefer at least 20% returns from the stock. So my discounting rate will be 20%, which means that I want 20% returns from this stock. So you will put 20% there. Now the next thing is terminal growth rate, which means that after 10 years, by how much the company will grow, which is very difficult to understand. So I usually take it at 1%. The company will grow by 1%, which is very conservative. So these are all the assumptions which you need to take. And then you need to put it in a formula which will give you your fair price and will tell you whether the stock is undervalued or overvalued. But you don't need any formula. We have made it very, very simple. We have made a calculator. You just input these things and it will tell you the fair value of the stock, and bingo, you can decide whether you want to buy or not. So come on in. I'll show you a demo of how to use that calculator and you will find the link below. So now let's tell you how you can do it very easily without learning any of the formulas. So just visit our website phenology.in. You will find a new calculator section here. Just click on that, and when you scroll down, you'll find a DCF calculator here. Just click on launch calculator, and now let's do a demo. Say there's a company which is an average free initial cash flow of 1000 rupees. Again, I'm telling you, this is right now a bit complicated to calculate. We have given the formula here, but for all the companies, this 3-year FCF will soon be available in our stock analysis website that is launching next week. So this figure you will get it instantly for any company once our website is live. Now discount rate. So this is the return which you need. So if you need 20%, so I need 20%. So I'll put 20% here. Now, what is the growth rate of the company? So if you see that the past free cash flow growth rate has been high or low or moderate, you can simply select that option. Here again, once our website is live, we'll tell you for each company what is the free cash flow growth rate. So you can take it from there. Also, you can choose custom and you can choose your own rate here. But let's take moderate. Now, what will be the growth rate? 6 to 10 years from now. So I prefer to take it as low, which is 5%. Now, what is the terminal rate? And we have given explanations here. So this tells you that at what rate, according to your estimate, will the company grow after 10 years. So I prefer to take this at 1%. This is the market cap. You just need to Google what is the market cap of any company and you will get. So let's say the market cap of this company is 10,000 rupees. Again, you'll get all these figures next week when our stock analysis platform is live. What is the current share price? Let's say the current share price is 50 rupees. What is the net debt? You'll again get this data very easily and on our platform as well. Let's say this company is debt free. Now, what is the margin of safety? What is this? Margin of safety is basically the probability of things going wrong. So despite all these assumptions, when you take them very carefully, your assumptions could go wrong. So you should keep a margin of safety between say 10 to 25%. So I am taking a margin of safety of 20% here. Now let's see what is the fair value of this company with a market cap of 10,000 crores and a free cash flow of 1,000 crores growing at a moderate rate, and the current share price is 50. Let's see. So as per this calculation, the DCF value is 39 rupees and the fair value after margin of safety is 31 rupees. So basically right now this company is overvalued and you should not invest in such a company. Again, you will be able to do this for all the companies, and all this data, be it market capitalization, net debt, initial free cash flow, growth rates, will be available on our website launching next week. So I hope that all this is clear to you now and you will be able to do DCF very, very easily. Also, what we have done is we have explained you the basics of each of these terms here so that you can understand, and if there's any confusion, you can just scroll down and learn about DCF here.